Hi, welcome back to this, the final session of the Corporate Lifecycle series. If there is a theme that's run through this book, it's about aging gracefully, whether you're a young company, a mature company, or a declining company. And it's so difficult to do. In fact, the word I'm looking for is the word serenity. It's at the center of so many different religions. In Buddhism, it's shamatha bhavana, which opens the door to insight. In Hinduism, it's a quality that you aspire to. In Christianity, it shows up in the serenity prayer. God grant me the serenity to accept the things that I cannot change. But serenity is so difficult to aspire for, especially in the context of a business. But let me be very clear. When I talk about serenity, I want to be very clear what I don't think it means. It doesn't mean that nothing bad will happen to you. It doesn't mean that whatever bad things happen to you and there's nothing much you can do, which is kind of a distorted view of karma. Serenity basically means accepting the things you cannot change and then adapting and choosing a pathway that reflects where you are. So I'm going to frame this session in terms of lessons for companies, lessons for investors, lessons for regulators. Let's start with company lessons. Growing old is difficult. It's difficult for human beings, it's difficult for companies. Don't let anybody tell you different. Transitions, remember we talked about those from startup to young company, young to high growth to mature growth to stable growth to decline. Those transitions will be painful and costly. And as you get older, there will be limits on things you can and cannot do, just there will be things you can do. And as companies age, there will be this nostalgia for times past, especially if you had a glorious past. In fact, I think more successful companies have difficulty aging because they look back at past successes. So as you age, you should expect discomfort. You should expect to find yourself doing things you did not do before. And anybody who tells you that you can do this effortlessly is lying. Second, survival. You got to survive as a business to deliver on potential. With young firms, the risk of failure is constantly around the corner. 2/3 of startups don't make it through year 2. With declining firms, the risk of failure is around the corner, especially with borrowed money. And for all firms, there's always a macroeconomic force that you don't control that can put you out of business. COVID for a hotel business. So there are, in fact, things you don't control. So I think as businesses, we have to acknowledge that failure is a possibility. We can't just close our eyes to it. We should try to do what we can to reduce the risk of that failure, maybe not eliminate it, so that we can keep going as companies. But it can't be something we completely ignore. So if you can reduce the amount of debt you have as you go into decline, and that increases your chance of survival, you should do it. If as a startup there are things you can do that reduce your risk of failure by, for instance, by having a bigger cash balance, by all means go for it. Third lesson, business always involves trade-offs. Almost everything we've talked about in this book has had pluses and minuses. So if anybody tells you there are things you can do where there are no minuses, everything is positive, they're not giving you the other side of the picture. At the beginning of the life cycle, for instance, you have to choose a business model. You can choose a low capital intensity model that allow you to scale up faster, but not stay at the top that long and decline faster, or a more long-term, more capital intensive model where it'll take you longer to get to the top, but maybe you can stay there longer. When you're a young company faced with the question of should I go for scaling up or should I go for a business model that builds profits? It's a choice you have to make. So as you go through with each stage in the life cycle, you'll face choices and you have to make trade-offs to decide which choice is better for you. For a declining company, the question is, should you go for a shrinking market and become less profitable, acceptance, or should you try for rebirth? Again, a choice. One doesn't always dominate, and the right choice might be different for you than for another company in exactly the same stage of the life cycle. Fourth lesson for businesses, building business is mostly perspiration. This has been said, I think it's Thomas Edison who said it first, but maybe there are people before, that success is 90% perspiration, 10% inspiration. When you build businesses, there is that inspirational part, the visionary part, the exciting part, but building a business is hard work. It requires perspiration, finding cost-efficient ways of delivering products, building supply chains, keeping your employees working for you. And if your founders are so focused on the exciting stuff and the inspirational stuff and not on the perspirational stuff, your business will not build up. So you need to spend time on business building even if it doesn't excite you, because that combined with vision is what makes for a successful business. Fifth, scaling up is hard to do. It's a lesson we've repeated all through this book. But as you get bigger, it gets more difficult to keep growing. That's what makes you age as a company. Your success has made you a bigger company. So if you look around you, though, we make heroes of empire builders, people who make their companies bigger and bigger. But scaling up a business comes at a cost. There'll be times when you scale up a business by taking investments that are not good. The incentives to scale up a business keep getting stronger, and if you're using other people's money, the tendency gets even worse. Scaling up is hard to do, and sometimes the best thing you can do for your company is to stay small. I know that cuts against the grain, but there's nothing wrong about being a small, niche, successful business, especially if it gives you a long life. Your end game, if you run a business or a publicly traded company, is to not make it last forever. I know, again, sustainability suggests otherwise. You can make your business sustainable, but that doesn't mean it should stay on forever. If the reason for your existence goes away, after all, a corporation is a legal entity, and your business is essentially no longer a good business, there's no reason why you should keep hanging around if the reason for your existence is gone. Notion that companies last forever is a dangerous one. There is this old country music song, it's you know when to hold them, know when to fold them. Knowing when to shrink and put your business out of its existence is, I think, a key part of running a business. We've been fed this notion that if you're a good management, then good things happen to you, and that if bad things happen to you, it was because there's something you did not do. And that's true for many things. But there are factors you don't control, macro variables, country risk, political changes. And you could be the best management in the world, and those things can conspire to bring you down. At the other extreme, there are companies that can be run by robots. AI could run these companies. The management actually adds very little. So while managers view themselves as the arbiters of success and failure, there are things that are out of their control that basically can determine success at many companies. But I think what we can do is build adaptable companies. So when bad things happen, acts of God, we can adapt to those changes. Let's talk about investors. First and biggest lesson, I think, is uncertainty is a feature, not a bug. You've heard me say that before, but essentially, we spend so much time hiding from uncertainty, viewing it as a problem, trying to make it go away, denying its existence. And as I've mentioned repeatedly through this book, the best way to deal with uncertainty is to face up to it. Look it in the face. Monte Carlo simulations, a way of facing up to uncertainty. Facing up to uncertainty will make you a better investor. In fact, your best investments might be in the places where you're most uncertain. Second, I have an analyst and appraisers claim to be objective. Stop lying. We're all biased. Be aware of your biases because they will play out in the business story that you hear and you want to be true. I mean, earlier when we talked about stories and numbers, when you hear an investor tell a story, when you hear a manager tell a story about a company, to the extent that you fall in love with the story, it's very difficult to ask the right questions. You can't do much about your biases, but at least you can try to be honest with yourself. So be open about your biases, put them down on paper, and that may make you a better investor because once you're aware of your biases, maybe your decisions can incorporate those biases. Investing is a skewed game. What does that mean? Your big winners are what carry your portfolio. This is especially true for young companies. Remember that picture you saw of venture capital investments? Those big winners are what make your portfolio do well. Now, that asymmetry in returns is what leads people to go looking for the 10 baggers, the big investments. But I think that's a dangerous game. If you get a 10 bagger viewed as icing on the cake, but when investors concentrate their portfolios, hold 4 or 5 or 6 companies saying, I'm going to get that big winner, the risk they run is they get none of the big winners and their portfolio will suffer as a consequence. Spread your bets, try to pick the best companies you can, And hope and pray you got a 10 bagger or a 100 bagger in the mix. But you can't let your concentrated portfolio represent all of your bets in a few companies. I'm going to repeat what I said earlier in the context of management. We exaggerate how much effect management can have on a company. But management quality can only do so much for a company. And there are conflicts of interest that you have. So as you look across companies, you worry about both management quality and you worry about conflicts of interest. When you're investing in young companies, it's the management quality worries that you might have, whether the founder is good enough to convert an idea into business. As you get to more mature companies, the conflict of interest that you worry about. Later on, we'll talk about how this plays out in corporate governance and how we have to think about corporate governance. But the data you collect on management should reflect where a company is in the life cycle, because what you worry about is very different. Much of active investing is built on what I call mean reversion. What does that mean? You buy low PE ratio stocks. Why? Because you expect them to revert back to the average. You buy a company with low margins, which is trading at low price. Why? Because you expect those margins to revert back to historic norms. In so much of investing in management, we assume that things revert back to the way they used to be. Not a bad assumption for the most part. It's a strong force. But there are two conditions under which mean reversion will break down. First is in terms of timing. You may revert back to the mean, but what if it take you 25 years to get there? Might be too late. The second is if there's been a structural change, a disruption, you may never revert back to the mean. Some of the biggest value traps, these are companies that look cheap but keep getting cheaper, are companies where you bet on mean reversion but you missed a structural change. 6, just because you invest in a good company doesn't mean you have a good investment. We drew this contrast in the chapter where we talked about the mismatch you're looking for. The mismatch is when you look at companies, you assess their management, you assess the quality of the management, and you assess it in terms of, is the management good at this company? But at the same time, the market is making that same assessment. Your best investments are in companies where you got a mismatch, where your assessment of the company's management is different from the market's assessment, and you're right. You want to invest in good companies the market thinks are abysmal. You want to avoid investing in good companies the market thinks is great. So think about management, think about what good management does, but also think about, what price are you paying for that good management? If you're paying too high a price, it might not be a good investment. Finally, as an active investor, you're hoping to take something away from the table, more than you would make investing in an index fund. But to do that, you got to bring something to the table. And what you bring to the table will vary depending on where you are in the life cycle. If you're a venture capitalist, your skill set that allows you to walk away with excess returns is your gauging of stories and founders. If you're a high growth company, it's your success at separating the companies that can scale up from the companies that cannot. With more mature companies, it's how good you are at assessing corporate moats. But think about what you bring to the table. What is your niche? What is that advantage? Because that's what's going to allow you to earn excess returns. Now, in finance, the lesson is a powerful one that you get early in the class. High risk and high return go together. But don't get carried away. Just because you take risk doesn't mean you're entitled to high returns. That entitlement is a dangerous place to be, because if you as an investor think you're entitled to higher returns and you don't make them, you get embittered and you start doubling down. So when you look across the life cycle and you think about risk, you're saying, I should be rewarded. On average, maybe the answer is yes, but there are lots of factors that might get in the way of you being able to capture that reward. So do your homework, assess your risk, get an expected return based on the risk, and if you don't get it, accept that that's part of investing. You can do everything right and have nothing to show for it. Finally, if you're an investor, if you're in markets, remember you can either be an investor or you're a trader. What's the difference? Investors value companies, so you've got to look at cash flows, growth, and risk, and find something where the price is less than value, and then pray and hope that the price moves to value. Traders buy at a low price, sell at a high price. Very different game. We talked about how the tools are different, how the mindset is different. There's nothing good or bad about either, But if you come to markets, you got to make a decision. Are you an investor? Are you a trader? If you're an investor, spend your time in understanding businesses, assessing value, making your best judgment. If you're a trader, make it all about detecting shifts in mood and momentum, because that's how you make money. The market is full of people who fool themselves into thinking there's something they're not. Investors who look at trading tools and traders who use investing tools are asking for trouble. Final point, and you're not going to like this. We're often told that if you're skillful, you're going to win in the long term. Not necessarily, and especially not in investing. Investing is a game where luck dominates skill. Even over long periods. What separates success from unsuccessful investors, even over long periods, is often not the skill that they brought in, but the luck, being at the right place at the right time. So when you succeed on an investment, be honest about why you succeeded. I've made a lot of money in NVIDIA, but I bought it in 2018 and I made money because of something I never foresaw, AI. And be humble when you succeed. Remember that your success could be just as much pure luck as it is skill. So luck is a big factor here. So if you're superstitious, continue to be superstitious, because that might be what makes you a good investor. But this is a game where skill can be drowned out by luck. Let's move on to regulators. Over the last 40 years, the amount of disclosure we've asked from firms, from both accounting and government regulators, is more and more. On disclosure, the rule seems to be, more disclosure is better than less, and I'm going to push back. I'm going to argue that as you require companies to disclose more and more, we have what I call disclosure diarrhea, where disclosures get bigger and bigger and investors learn less and less. They start to ignore disclosures. In fact, as you look at data, converting it to information becomes more difficult when I drown you in data. Behavioral research suggests that if you want people to pay attention to disclosures, you need less. So I would suggest something similar to what I have in my what my wife calls my closet rule. If I buy something new, something has to leave. Maybe in disclosures, if you add a disclosure, you got to remove one. Less is more. And what you require as disclosure should vary for companies across the life cycle. Early in the life cycle, I want disclosure about potential, about total addressable markets, about the idea and business model. As you go through, what I require companies to disclose is going to change, because I as an investor care about very different things. This notion of one size fits all doesn't make any sense. So I want disclosures to be targeted and reflect where a company is in the life cycle, what sector it is in. It'll be much more useful for people reading those disclosures. And on corporate governance, if you look at how corporate governance rules have developed over the last 25 years, they've been written for mature companies where you worry about managers not knowing what's right for shareholders. And you talk about the separation between managers and owners. But the corporate governance concerns I have at younger companies might be very different. I'm worried about inside versus outside shareholders, or what venture capitalists are doing in the company. So what I might require as corporate governance rules should vary depending on where you are in the life cycle, because the governance challenges you face are different depending on whether you're looking at young companies or older companies. How about investor protection? I know that governments and regulators think it's their job to protect investors from being exploited, and they're right. But they also seem to think that investors invest in risky companies because they don't know there's risk. I don't think that's true. So requiring young companies to disclose that they can go under doesn't help anyone. So I think investors need to understand that, regulators need to understand that investors often invest in risky companies knowing that there's risk. So when you seek to protect investors, you need to understand what you're protecting them against. You can't protect them against making mistakes. They will make mistakes. You can't restrict investors to being just sophisticated, assuming institutional investors know more about risk than individual investors, retail investors, is, in my view, a mistake. And I think we need to separate out protection from company risks versus risks that affect the entire market. Company risks are risks that investors should be able to diversify whether they choose not to. So as you write investor protection rules, those might be factors you want to keep in. Finally, for policymakers, one of the things that I've wrestled with over the last 20 years is this balance between risk capital and safety capital. Risk capital is capital invested in the riskiest investments in the market, young companies, high yield bonds. At the other extreme, you have safety capital invested in the safest assets. And then you have subsidy capital, which is governments directing money to businesses that they want to grow. I think risk capital is what makes economies grow in a healthy way. It goes to risky businesses. Sometimes it succeeds, sometimes it fails. Subsidy capital, though, often creates business models that should not survive, but they're surviving because of the subsidies. I think one reason the green energy business has not developed legs of its own is because so much of the capital going into green energy has been subsidy capital. Then there's top-down versus bottom-up. A lot of policymakers think that they can change the way investors and businesses behave from the top down by passing laws and regulations. Much of the Middle East has been trying to create an entrepreneurial mindset top down. Governments try to encourage it. But ultimately, if you think about entrepreneurial mindsets and thinking like an investor, allowing for risk capital, it comes from the bottom up. It's got to be something organic, developing from investors deciding that they're willing to take on risk and deciding they're okay losing money. And finally, if you look at timelines, policymakers are driven by election timelines and artificially set timelines. There is, much of the change we're looking for here doesn't come with a timeline tied to elections or what happens, around a cycle. So it's something that policymakers need to keep in mind as they look at how do we encourage young companies in our economy. I think it's not something that's going to come from the top down. It has to come from the bottom up. It has to come from investors investing in those companies and business founders willing to be starting those businesses in those countries. I hope you found this session useful, and I thank you very much for listening.